future. We're talking real money.
Remember when you put money in the bank and it just sat there and didn't do a doggone thing? It just sat there and was money, and it didn't make you any money. It didn't give you anything back. Remember when you had that bond fund that paid you so little you didn't even notice it was actually paying you anything? Remember when interest rates were low and yields were pitiful? Well, it was tough to figure out how to generate an income from your portfolio in retirement when there wasn't any income coming in from pretty much anything, and people did a lot of dumb things, like bought junk bonds or preferred stocks or high dividend paying stocks. And, well, that wasn't a good strategy. So now that rates are higher, is it better now? Are you set now for retirement with rates in the 4 to 5% range on really safe stuff? Like, can you just take the yield from your portfolio? That's what we're going to talk about today. I'm Don McDonald on the East Coast. Tom Cock is covering the West Coast. He's our West Coast correspondent, and we got the middle of the country covered somehow because our signal is leaping across it. But does the current interest rate environment mean that you can live off the cash flow from your investment portfolio?
Yeah, I think it's a great question. And obviously, we're in a whole different interest rate environment, as you point out, that even as recently as a couple of years ago, when you're basically getting nothing. Now, this comes from a piece from Christine Benz, who writes at Morningstar. Love her work. I've heard her speak several times. Think she does a really good job.
I really, truly admire her dad, Mercedes. Oh, that's her mom, Mercedes, isn't it?
I mean, that was going to be in there somewhere. I was hoping it was going to be me, but I'll let you.
No. I had to beat you to it.
I appreciate
because you were going to go for the car.
I was going to say I thought I'd make Lord it and Mercedes or something in there, but
yeah, no, I thought I'd make it apparent. Mercedes Benz, remember her? She was old silent screen actress.
Exactly.
I think it was her grandmother or something. Yeah.
No, I remember you were in the theater watching her. That's all I remember. Okay, but she makes a good point that today, according to her numbers, a basic 60-40 portfolio, 60% in the S&P 500 index exchange traded fund and 40% in a total bond ETF would pay out 2.6% based on the SEC yield of each holding. So 2.6%. So you could just take that, put that in your bank account.
And the SEC yield is the current calculated yield based on the price of the fund and the income coming in. Yes.
Exactly. So you could take that and you could just put it in your account, right?
With $1 million, you're going to be taking out a little over $2,000 a month.
Yeah. So that's one.
Is that enough to live on?
Well, that's a whole other. Generally not, but depends on how many millions you got and how much you're spending, right? I mean, it's but I don't think that's the question on the table. The question on the table is that the correct strategy now that interest rates have gone up? I just met with a couple that has, was it $3 or $4 million in some sort of bank, and they're getting 4.5% on it. That's a lot of cash. Now I looked at that and thought, well, but you could put that in, you're going to get a smaller yield, but municipal bonds, so you're not paying tax on all that interest income you're getting, which sounded like a whole lot to me. But the question still, this is something people bring up. Look, just turn the dividends and interest, all that stuff on. I just want to get that payout. That'll
and leave the principal alone.
Leave the principal, and then I don't worry so much, right? So is that the right strategy? Because she talks about 3 different strategies in this piece, which I think is worth reading. It's at Morningstar. As I said, it's entitled "What Higher Interest Rates Mean for Retirement Cash Flows." So one strategy would be turning it on, getting that income paid out to you, right? That's a strategy. The other one would be the second one. She says reinvest the income, use rebalancing to generate cash flows. So now you have the income, the dividends, capital gains, that just goes back into the portfolio. And then when cash is needed, you rebalance. You take from the things that have gone up, you put that in your pocket, and in some cases you have to put them in things that went down. That does a couple of things. That makes you sell high and buy low, which most people don't want to do, right? Because that's going up. Why would I mess with that? It also then allows you to reinvest all that stuff. It actually helps sustain the portfolio more than sucking off the interest and the dividends, which people have a tendency to forget or have been a large part of the returns for a long time, right?
Right.
they forget, like, well, that really helped the return of the stock market, right? Because I wasn't sucking off all the stuff that they were spinning off, right? I'm sorry, did that come out wrong? Oh, Jesus.
It nearly got me the first time you said it, but when you did it the second time.
God damn it. All right, should we just start over again? I gotta write that down so I don't say it again.
Don't say sucking off your portfolio.
Yeah, but you can get the dividends and the interest all right there. You get it all right there.
And then you get a big surprise at the end.
God damn it.
Gonna cry. All right, I'm going to leave all that in. All right, this is this could be the E edition. I'll edit it. Let's just keep going.
Right. Okay. What can I go back and at least take out the second sucking off?
Take out the second sucking off.
The next strategy would be, instead of collecting, drawing off all of the interest and dividends.
Drawing down the interest?
Drawing down, right?
Yeah.
Taking it out of your portfolio, among other ways you could
milking it, draining it.
So instead of doing that, you take the income, the dividends, capital gains, and you push that all back in the portfolio. Then when you need cash, you rebalance, you sell the things that have gone up. Some years it's stocks go up more than bonds, some years bonds, etc. You take that money from the portfolio after it's done what it's going to do for the year, whatever period of time you need to rebalance. That makes you do this thing that we really love in investing called selling high, right? And putting money
low.
Yeah, putting money into things.
Or taking the money out, yeah.
And it allows you also to have control over the withdrawal amount. Conversely, if you're just waiting for an interest payment, then that can go up or down depending on a number of factors, especially with fixed income. So this is the problem with this one, of course, is sometimes everything goes down, right? Rarely, but it happened in 2022. Then you had to drop, some from another. Okay, that's strategy number 2, according to Christine Benz. And by the way, that's my favorite strategy, but we'll talk about that in a minute.
A variation on that, though.
Yeah,
I want to modify that later.
Correct. And strategy number 3, she says, is spend the income and use rebalancing proceeds to supply the difference. In other words, you're still taking the income out, and then when you don't
have enough income,
right, you have to rebalance. You have to sell things to pay those additional expenses. So is it door number 1? Is it door number 2? Is it door number 3 for your portfolio?
Well, Monty, I think I'm going to take door number 4.
All of
the above.
I see. All right.
I want all of the previous doors, because here's what I believe, and she kind of alluded to this. Your strategy for taking income should be flexible. Therefore, there will be years when a large part of your income may come from the dividends and the interest. And if that's the case, great. If there's not enough, then you take it from the rebalancing. If there's not enough, you sell some things and you get it then. Because what you want to do is create a portfolio that returns the number you need, or close to it. Now, if the number you need is 98% of your portfolio, that's only going to last about a year. But if the number is in the 4, 5, maybe even 6% range annually, and you can adjust your portfolio based on market conditions in the previous year, you can adjust your income stream. To me, that is the perfect strategy, because it really does, basically, with a diversified portfolio in almost any scenario we've ever run, make the money last in a well-diversified portfolio for the rest of your life.
Yeah, and that's the part that people have a tendency to forget, that what you're really trying to do is sustain the portfolio. And the best way to sustain it is to feed it. Mm-hmm. So if you take all the nourishment
along the way, right?
Yeah, if you take all the nourishment from it, then guess what? It doesn't work as well. But I will steal this also from Christine Benz. This is her line, not mine. I love it, though. The only correct withdrawal strategy you will know will be after you're dead.
Yeah.
Right. And we don't know for sure on any of these. I love Don's because it suggests that sometimes you live off a little bit more and you do go crazy. You take everybody to Arizona, whatever. I'm not going to give my bad analogy with all that, but sometimes you have to spend less.
Oh, you
right?
mean the Wet and Wild versus Hawaii
wild
one?
And, that one, because it's been killed more times than Rasputin.
What's it called?
Wild Waves. Wild Waves.
Wet and Wild is the old place in Orlando years ago.
Wet and Wild's a whole different place.
Yeah.
But being flexible is really imperative in so many ways, because it should be in your life, because some things are one way, another way, but it should be with your finances too. You shouldn't be so drilled in, I got to have this much every month, but some of you do. That's why this is what worries me about this article, and what worries me about using strategy number one is, guess what? You switch to that. Okay, yes. Then you got to switch
do it
back
for as long as it works, right?
I know. And then
like, for example, I was curious. I was curious if I could go out today and create a 10-year treasury ladder. What would my average return be over that time?
Wow, on a 10-year
treasury ladder,
I'd say
right now,
4.6, 4.7.
About 4.4.
Yeah, I mean that's not bad, right?
No, and that's
a
over
long
10
time.
years.
There you go. Yeah.
Now, but what that does is, it does mean though that if you're laddering, your maturing security is at the whim of the future market, which we don't know. It could be lower, could be higher. If it's lower, then that average yield is going to drop a little bit for the next year, and then drop a little bit more for the subsequent year. But first year, it's about a 4.4, 4.5 average, which is darn good.
Yeah, that's quite a bit of money. And in something that you've always been paid back at, and you haven't had to worry about the principal.
Yeah, it's a very, very safe strategy.
Indeed it is. But again, I don't like people jumping in and out of. I would prefer you to have a strategy and then stick
if
with
rates
it.
go way down, people are going to be jumping out of that strategy and trying something new that could just be terrible.
I
timing is a terrible thing.
But before you even get to that, this is the thing. We always have a tendency to jump to dessert. You got to have the salad first. The salad first is having the strategy for withdrawal, having the correct asset allocation.
Unless you're European, and then the salads later.
That's a good point. And not paying too much to others, because again, just saw a mutual fund today that somebody's paying 1.3% for. You got to do the basics. And in today's world, you don't got to pay anybody 1.3% for a mutual fund. Thank you very little.
Did you just say you don't got to pay anybody?
I know. I'm really working on my English over here. On the West Coast, things travel slowly.
You guys are a little more chill about your language, about grammar.
Exactly, which
punctuation
comes and goes like the portfolio. So be flexible.
Innuendo.
Don't change in and out of the portfolio. Yeah, I'm not having a good day there.
Do not suck off your portfolio.
Exactly.
Just
because
don't do that.
It'll go down, down, down. It's not good. So
I'm so sorry.
I know. It's horrible.
But this is the podcast.
So
and this would actually even be totally acceptable for broadcast. But.
Well, let's not find out. What do you say? So, yeah, I think this is a comfort level. And for my comfort level, I've seen portfolio sustain for a longer period of time using option 2. That's why I'm comfortable with it. Could the future look different? Absolutely. As Don just pointed out, I think it's a great example. You can do 10-year and get over 4%. That's pretty doggone good. And you're going to get your principal back.
Yep.
Nothing wrong with that.
Yep. Nothing wrong with that. And you know, there's actually even a way you could play with that little number. You could take 80% of your portfolio, because you want a pretty steady income of about 4. 80, 85, whatever the number is going to be exactly. And then put the rest in a diversified, aggressive equity portfolio, like a small cap value to
give you some growth. Yeah. There you go. Feeding it. I love it. That's great stuff. So thank you, Christine, for that wonderful article. I think the work that they do at Morningstar generally, I hate the, here's the best fund, blah, blah, blah. That's a bunch of nonsense. But in a general sense, the topics they address are important, and the way they address them, I think, is good, is fair, is
their
reasonable.
Editorial stuff is very, very good. I do think sometimes they pander just a tiny bit.
They have to.
Their actively managed, overpriced clients.
Exactly, because that's who their clients are. All right, couple of questions. This one comes from your nape of the neck woods, I guess. OCOEE, Florida.
Coe.
Ocoee. I don't know.
It's just up the street.
Okay. All right. Well, this
Close
is a
by.
neighbor of yours from Ray.
If you come to Florida, I'll show you Ocoee.
Please
it won't
don't.
Be a big moment for you,
Actually, we're coming to Florida. I think I haven't even told you this. I'm going to Puerto Rico to see relatives in
sir,
November,
that's
December.
In the Caribbean. That's
I know,
not
but
in
we
Florida.
have to stop in Orlando. We're going to stop for a day and see you.
We do have a lot of Puerto Ricans in Florida, but Puerto Rico.
I'm going to the actual island because I have relatives there. Believe it or not. So
Tom actually is Puerto Rican.
I know people. They fall.
You need one of those little flags and hang it off your rearview mirror.
You won't quit laughing when I come back to the place. Are
you going to come back with one of those?
And no, I'm going to get elected governor. That's my plan. Do they have a governor? What's the leadership in Puerto Rico? Okay, I don't know who the governor of Florida.
Probably
my grandfather's a very famous Puerto Rican. Laugh all you like. Ray writes
the only blonde, white, sunburned Puerto Rican in history.
I think there's somewhere in Spain that there were some blue-haired blondes or blonde-haired blues, blondes, something like that. Anyway, I knew I was going to mess that up. All right, here's the actual question, Ray. Sorry.
Yeah.
I do not pay Edward Jones any percentage fees. I only pay when I make a transaction. Mm-hmm. What fees is Edward Jones charging me that are obviously not apparent to me?
Well, there's the 5.5% or 5.75% or 5% commission that you pay to get into the funds. It's probably 5.5, 5.75 because you're probably in American funds. That'd be my guess. Then you have the annual fee charged by the fund.
Thank you.
Which runs between about 0.6% to maybe 8 or 9,
yep.
and 0.25% per year goes back to the broker as what is called a trailing commission. It's just to encourage them to not let you slip from Edward Jones's grip or American Fund's grip. But they get paid a big fat commission up front, and then they get a fee along the way. Generally speaking.
In addition, Edward Jones, big piece in one of the local.
The kickbacks.
Well, no, they're getting more into asset management now because they've looked at the rest of the world and say, wait, this is what registered investment advisors are doing, and they're collecting a fee for this. So we just had somebody come in that was, in addition to paying commissions on some products, they're actually managing separate money and charging 0.5% for that. So I don't know all their fees on those.
Are you sure
sort of
it was as low? It was that? Because
it was that low. We looked at it. So, but I don't know what else they were paying. I only know that part of it. So
I know their ADV starts out at 1.35.
Right. So they'll manage your money, but it'll be more expensive. And the funds they use will this is the part that people forget. You could pay a management fee, and then you're also paying the funding. So let's just to say you say 1.3%.
1.35 is their up to $1 million fee.
Yeah, and then let's say you're paying 0.6% for the fund. Now all of a sudden your expense is 2% total. You got to add that all up. Very important thing to do. So many ways they could charge you. Kathy from Lake Stevens, Washington. I know the place. Good place. Writes, harvesting loss for tax purposes. Do you ever advise using the strategy if one is well diversified and can conceivably benefit from such a strategy? Tax loss harvesting. Sure.
Yeah.
Yeah. We both did it a couple of years ago. It worked out really well.
I'm not by any means, any stretch of the imagination, a major investor. I mean, my portfolio is not that big because I started a lot of small businesses in my life and really didn't accumulate as much money as I should have.
Some worked, some didn't.
Some worked, some didn't. Anyway, whenever I see an opportunity to tax loss harvest, I look at my portfolio every quarter or so, if that often, at least once a year. And I look and see if there are any losses from what I paid because I use ETFs. It's so easy for me to sell one and buy a different one that's slightly different. But if I go from DFA to Avantis or Avantis to Vanguard, even if I'm in the same asset class, I'm safe because they have slight differences to the portfolios. And take that tax loss. It's so helpful. Yes,
it is. It was, and for both of us in 2022, it was a great thing. And I remembered at the time thinking, is it going to be a really big deal? Yeah, when I did the taxes, that was a huge deal.
It was a big deal.
This is from Peter in Chicopee, Massachusetts.
Chicopee.
Glad you're there to help me on that one. About rebalancing. Is rebalancing my 401k portfolio from winners to losers the same thing as timing the market?
No.
How would you go about
No.
rotating, rebalancing from winners, Russell 2000, Dow, and NASDAQ funds on 50 with a very high risk tolerance?
No, because you're not wholesale selling all your winners and buying all your losers. You're just moving enough to maintain your portfolio balance, which you need to make sure in advance is the appropriate portfolio balance for what you need the money to do and for how much risk you can tolerate.
And if you're doing it between,
it's a discipline. It is not timing.
Thank you. That's the exact right. But if you've established, look, I'm going to have this much in large cap, like the S&P 500. I'm going to have this much in technology, like the NASDAQ. I don't recommend that as
no. That's
owned.
sector moving.
I know. And then if you say I'm going to have this much in small, because you mentioned the Russell too, that's established for you, right? You're saying that's how much I want to have in each one of those asset classes. Then if you're doing this on your own, maybe at the end of every year, maybe it's your birthday, whatever it is, you look at those and say the percentages have changed. Now you're doing this in a qualified account, so it doesn't matter. There's no tax ramification. You're selling the ones that have gone up the most, moving that into the ones that haven't, back to the original percentages. And you're not basing that on recent, like, here's what happened yesterday kind of performance. This is a lengthy period of time. This should not be in reaction to some market temporary action. This get to back to the original percentages. So it's not a market timing move. That's
you don't do it when you go, oh, this is up, I'm going to sell it. No. That's why we believe rebalancing needs to be on a schedule.
Thank you. That's exactly right. Okay, one more quick one. You're going to be shocked.
You got a bunch.
I've got a lot more than this. This is going to surprise you. It comes from Ted in Renton, Washington. This is going to be a big surprise for you.
Why
Don.
does that surprise me? That Ted's
the question is going to be a big surprise.
Oh, okay.
Why invest in bonds if stability and not losing is the goal? CDs do never lose original principle, just buying power relative to inflation. Wouldn't CDs be more prominent based on don't lose money even compared to bonds?
Sure. Actually, yeah. I mean, if it's a not lose money thing, but that's not why we suggest bond funds. What we suggest with bond funds is the greater diversification and the ongoing market a rebalancing that they're basically doing. They are a fund is automatically rebalancing. It's getting you the newest bonds that are coming out while maintaining. It's like its own internal ladder. The only thing you can lose is but even with the CD, see, this is where we don't totally, it's not an apples to apples comparison. We don't grasp the whole picture. If you have a CD and you hold it to maturity, you get everything back. If you have a bond and you hold it to maturity, you get everything back. But if you want to get out of a CD or a bond before it matures, which is what a bond fund is giving you the opportunity to do by being publicly repriced every day or every second, if it's an ETF, is get out and possibly take a loss or possibly get a gain along the way. You will lose money if you try to sell a CD and interest rates have risen dramatically and you need to get out of it. So you still have volatility with a CD or a bond. You just have a lot more control over when you take that.
And how much capital appreciation should you look forward to in your CD?
Zero.
Yeah, this is the part that, I mean,
but with a bond fund, you really shouldn't. That should not be an expectation.
Historically,
not be an expectation.
They've provided some over time.
Because rates fell.
But over the long haul, they've made more than being in CDs. Now, this is a strange time.
Because they have had those higher yielding securities in there from the olden days, from years ago. And now what's happening is we're starting to see the yields come up and the values have improved dramatically as rates have been rising.
But what Ted is asking
settling. I'm not saying
just
settling in.
What he's asking is, I think, should I replace the bonds in my portfolio with CDs? I would not do it.
I don't have an issue with it. I don't have an issue with it.
I think
but here's the problem:
investment,
short term. Do CDs, but only if you are 100% confident you will maintain a laddered discipline. If you cannot maintain a laddered discipline, you're going to end up being an interest rate timer.
Which everybody will be, and you've seen
most people will end up being that. Yes. If you can, and you can, create a 5-year CD ladder, and at the end of every year, immediately buy a 5-year CD. Immediately. None of this second, I think rates are going to go up just a little bit, so I'm going to wait. No. That's the problem with CDs.
I would still rather just have a total bond or something similar fund. That's just me. So
I'm not opposed to either, but the bond fund for most people is going to be easier.
Yeah. And they'll do it because they don't have to do anything. It's all done for you.
We don't like to do things.
You can get it for almost anything.
We as human beings tend to overthink everything? Yeah.
That's another big problem, sure.
Yeah. Oh, let me just think about that for we did this last night at our homeowners association meeting. We got into an argument over building a playground and how to build it and whose idea should win. And we've been doing this. The previous boards have been doing this for years. And I said, guys, we are overthinking this. Build the playground. Nobody's going to care a year from now. They just want a playground.
I would be
paralysis by analysis.
But you make sure you add in at least 6 to 8 pickleball courts, and I sign off.
It's a playground for little people, dude.
Okay. Well, every playground now has pickleball courts on it.
No, they don't. It's a playground.
Don't overthink it. Go with the pickleball.
It's not for people playing pickleball. See, this is the problem. It's people like you who argue at our meetings.
You're not supposed to use you messages either. That's what my ex-wife told me.
Which you made that rule?
She did. She told me don't use messages.
Oh, okay. See, we're
trying to live up to it.
We all think we're so bloody special.
Exactly.
All right.
Hey, if you need a little help, well, let's just remind people, and we've had some great conversations through the last few weeks. We get into the nitty-gritty on some of this stuff. And if you get the big picture stuff right that we talk about, right? Having a plan, having the right asset allocation, keeping your costs low. For most people, like Don said, you'll be okay, right? The playground will work. Yeah, it'll work. But most of you aren't doing that. So ask for help. We give you a free period of our time. Don says an hour. It ends up being more than that in many cases. That's fine.
You went over without charging
anybody.
People?
Don't tell the boss because that'd probably be the end. Anyway,
you
simply go to talkingrealmoney.com, click on Meet an Advisor, and we work with you. We help you. And yes, I'm taking Saturday calls. I think I have next two Saturdays all lined up. So happy to chat it out with whatever your situation is and whatever help I can provide. Love it. So
you're just fired for arguing with me about the playground.
And the bonds. I'm done. That's 2.
Yeah. All right, folks. Thank you. Thanks for being there. We really appreciate you, and we truly appreciate it when you tell others to listen. Now, I know some of you hate us. You hate the banter. It's okay. If you don't like it, you don't have to listen. But if you do, thanks for doing it. And we truly are. The thing is we really, truly are trying to help people become better investors and better money managers. That's the bottom line. Whether we do the playground the way you want it or someone else wants it.
Put the teeter-totter over there, would you please?
Build the darn playground. I don't even think they do. The teeter-totters are weird now.
Okay.
They're putting in artificial turf. Everybody wants artificial turf.
Yeah, of course.
2 inches of padding under it and all that stuff. I'm going, the mulch is fine. No, mulch, could have glass in it. I'm going, really?
Mulch has glass in it?
Well, because the kids, the teenagers partying in there could be glass in there. I said, I seem to remember when I was a kid, we just played like on concrete and gravel and then had knees with holes in them and blood everywhere. My kids played on like sand, and now they want padded turf.
There's a message there, which I am not going to respond to. So I'm leaving it there. Yeah.
Anyway, thank you so much. Take good care of yourselves, and please join us almost every weekday. Sometimes we take a day off when we sit around and gab and talk real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?